And we're live. We're back with more podcasting action. Back with a new episode live taping of ENJINSTARTER Saloon. So before I bring on my next guest, here's a short intro. Mr. Kelly Choo is the founding partner of, Choo Venture Global. Suddenly, mind freeze for a moment right there. His passion is to create a positive impact on people's lives through the usage of technology. He's the founding partner in Choo Global Ventures, TGV 4+ Fund, investing in global serial entrepreneurs that can disrupt industries with blockchain. Now with 2 unicorns. One more actually recently went public, and one is going public. He started to invest into blockchain gaming, now NFT gaming space, back in 2018, and have been active in the space ever since. He's also a co-founder of Refer Rich, a peer-qualified trust-based network that makes networking, deal sourcing, and solution seeking more effective, efficient, and scalable. He was previously co-founder and general manager of Brandtology, a leading social media intelligence company that was acquired and then listed. He was also CMO for a brain computing interface platform called Neuro that helped individuals and companies to understand a user's mental states. He was recognized as the Singapore Computer Society's Young IT Professional of the Year in 2012 with other accolades like Outstanding Alumni. So without further ado, let's bring him on to our virtual podcasting studio. How are you, my friend?
Great. Thanks, Wayne. Thanks for inviting me. Very happy to be here.
Very happy to see you too, my friend. How's your Monday been so far? Tell us, exactly which part of Singapore you're residing in, and what have you been up to the whole day today?
I'm in the center, the epicenter, almost epicenter. So everywhere I'm equally far, right, in Singapore.
All right. So, we want to actually get cracking, and I prepared actually a bunch of questions, especially related to venture capital. That's always a subject that I want to cover, in my network of podcasts, but I never had the opportunity until Prakash, bridged us, and now I have this, fantastic moment and actually do this one-to-one with you. So without further ado, let's go and talk about the first hot topic. Yeah, we want to talk about venture capital, which is the first time we're covering in this show, which is normally about metaverse, blockchain, crypto, NFTs, AR, VR, and even future of work. So before you do, can you just give our audience some sort of like background of what you have done, maybe a short version of your career so that they have some context of who you are?
Sure, absolutely. Thanks, Wade. Yeah, so basically my career, if you want to call it, right, started, kind of early when I was in Polytechnic. I guess, it's just before university itself. So I was, I think, 18. I went to Silicon Valley. I had a great privilege, and I was very appreciative of this from my poly, which is Ngee Ann Poly. We went to Silicon Valley, I think it was 2000 or 2001. Can't remember now, it's a bit hazy. But that was when, things really, opened up my mind, right? I visited, I think, Apple at the time, the Apple store. And I think at the time, Steve Jobs just came back after being fired from his own company. Was very, very inspired. And a Singaporean VC, actually, one of the trailblazers back then, met with us. And I asked him a very simple question. I asked him, so what's the latest things that I should be focusing on, right, as a young person? And he said, Kelly, there's this company called Google. It's growing, and it's becoming something. And in my mind, I was like, oh my God, there's a new challenger to Yahoo and Lycos and Alta Vista, right? Those kind of old names that are out there. So I was very, very intrigued. And when I came back, I started coding this search engine, right, for my final year project in Polytechnic. And I thought, yes, now with technology, I can rule the world, right? So I asked my parents, help me, register a company, and just let me run this thing. So they're very kind, they're very nice. They're not, business people. So they just helped me register. And, lo and behold, I had a company. And I asked some of my good friends, join me. Let's go and try to rule the world together. And you know what happened? Basically, army happened. And when we in Singapore, we basically when we had to start a company, you can't run a company when you go into military service, right? So that was my first failure, right? I didn't know how to monetize. I have no idea how search engine work. I mean, apart from the technical side of things, of course. And that was how the entrepreneurship bug bit me. Long story short, I was involved in 2 other startups when I was in NUS. And my 4th startup, right, when I graduated, was started in 2008. This was the social media analytics company called Brandtology, right? I was very, very lucky. I I met a mentor that was 20 years my senior, serial entrepreneur, took me under his wing. Mr. Eddie Chow, he's a kind of a legend in at least in Singapore. This VC as well as angel as well as entrepreneurship space. He took me in, and I learned a lot. Right, so we managed to grow this company to 300 people, 12 countries, and we sold it right within 3 years. I still remember the conversation, at the time, and they said, "Hey, isn't Facebook for kids?" This is exactly the same thing I'm hearing now when they say, "Isn't TikTok for kids?" Right. So when we were lucky, we were at the right time, right place. We raised venture capital, became dominant in the region, including China, and then we sold it. And then I worked for them for another 4 years. So that was really my first real job, outside of graduation. And then I started to invest, right, with a little bit of money that I got from exiting. Got into investing mostly in the VC space through a fund, and started to angel invest on my own, and started to learn, right, on all the hardships, what not to do, what to do as an angel, really the hard way. And then now I'm onto my 6th startup, and really happy about that going forward.
What an exhilarating career. What a ride. And, when you mentioned about rule the world, right, it reminds me that song by Tears for Fears. Everybody wants to rule the world, right? Who doesn't want to rule the world? But I think that the most important thing is that you're creating more opportunities. Of course, you're creating more jobs at the same time when you're actually, acting as an angel investor or as a VC, right? So that is definitely, a place that we want to maybe go deeper into, and I want to maybe talk to you about. And the next question, of course, is going to be about your basic investment thesis, because you are now a very savvy investor and someone, who is really crushing it, in this space. So when it comes to giving money to startups, especially, or even companies, right, do you look at the traction, or do you look at the team, or even TAM, which stands for total addressable market, right? So how many companies have you invested as a founding partner at TGV, and also as an angel investor, and how many unicorns you have in your portfolio or trending to get there?
Right. So great questions there. I think once when I exited in 2011, that's almost 10 years ago, right? Or more than 10 years ago now. Basically, I was in the dark, right? I didn't know anything about angel investing. Companies would come to me, startup companies, and I would look at them and say, this looks interesting. Why don't I put in, 20K or 30K or whatever, 50K or whatever amount, right? And I learned really the hard way, right? Through either investing through funds or even directly into angel investments. And then I met Dushan, who is the founder of True Global Ventures at the time, Fund 2, and he just moved his whole family basically to Singapore and tried to start Fund 3, right, in Singapore. This was 2015. I was very convinced by him because, number one, he told me very, very clearly about True Global Ventures in terms of the thesis, which is, number one, we only invest in serial entrepreneurs. This is something I understand because, as a serial entrepreneur, I know how hard it is. I can empathize with, the entrepreneurs themselves. So one of the main theses is that we only invest in serial entrepreneurs. Second, they must put in enough skin in the game. That means they must have put in their exit money, some part of it, into the new venture, right? So that we're aligned. It cannot be just other people's money all the time, right? I think that will not fly well. And of course, the third thing is that they must be doing something that is disruptive in their space, whether it's in fintech at the time in True Global Ventures 3, or now in True Global Ventures 4, basically into blockchain. So we are looking into things that are disruptive, that they are slightly early at the time, right, in True Ventures 3, but now we focus a lot more on later stage companies. So in 2018, we were very lucky 2019, in fact, 2018 was where we got our license for MAS, but 2019 was where we started to invest into, we started True Global Ventures 4, right, and we started to invest in those blockchain games, right? They call themselves at the time. No such thing as NFT games or GameFi or anything like this. So they're very, very early. So we were thinking to ourselves, how would actually mainstream users get into this space? We don't see, the less, the less tech savvy people coming in any way, because at the time, even now, right, setting up a wallet, making sure your seed phrases are safe, having cold wallet, hot wallets, whatever, right? Just trying to figure out the whole thing. If you are someone that's not so savvy, you probably will not get it so quickly, right? So we realized that gaming was probably something that was on the frontier because, gaming was driving, hardware sales. It was driving, early adopters. It was driving really a lot of these spaces that needed to adopt new technology. So that was how we actually got into it. And we said, okay, our mandate has to be, number one, serial entrepreneurs. Number two, enough skin in the game. Number three, they're into frontier areas in blockchain, right? In this case, NFTs or any other areas, right? That we believe that is going global, right? The reason why we're called true global ventures is because we aspire to be truly global. Today, we have about, I think, 40 over partners in about 20 over cities. Most VCs will, only invest in based on their fund, right, on the geographic area that they're very familiar with. But we thought from day one that we needed to spread our partners across the globe to be truly global. At the same time, to be able to pick and spot entrepreneurs that we want to back, that has all these different ticks that we're looking for. So I think it was something that we gradually built, obviously from Fund 3 and now to Fund 4. Yeah, and to your point about the unicorns, yes, I would say we are extremely lucky. At the same time, our our portfolio has been working very hard. I still remember very clearly Animoca Brands, who just was announcing their unicornship, if there's such a word, in July. They took many years to get where they are, right? Before they were focused on very traditional games, and then when Yat, the chairman, and who's also a partner in TGV, he said, I wanted to focus a lot on blockchain and blockchain gaming because he thinks that's the future, right? In those early years when in 2018, 2019, when we backed them, there was no talk about this. Everyone said, you're crazy, it's so niche. Why would anyone want to play blockchain games, right? And today in 2021, it's a whole different story, right? With Axie Infinity and all these other guys coming on. But it's just at the start of the story. Yeah. So I would say that it's a combination of luck and obviously a combination of the portfolio being extremely good at executing. Yep.
Congratulations on your new addition to this unicornship. Yeah. I think Animoca Brands is definitely one of those blockchain gaming, or should we say, all these NFT gaming startups that are doing really, really well. And Yasu is someone that, everybody wants to meet these days. Yeah. And of course, we have a question regarding Yasu later on in this later segment of the show. So you're also a serial entrepreneur. Yeah. And maybe someone who has been on both sides of this whole capital begging and giving game. So what is it like raising money? And what exactly is the process? And what did that entail? Is your job to deploy capital?
Yeah, so I would say that it's not so much begging, but more like convincing, right? Or some people say convincing, right? To con them and then convince them. So I think it's about trying to convince the investor why they should place the money with you, because obviously they have a lot of opportunities everywhere else, right? So why you, number one, and why and how much, right? I think this is a very, very key part about being on the side of the entrepreneur, right? To convince them that the story is there, you're on a trend, the timing is key, right? Because there's some research that showed, I think, John Dewar was talking about this before, that the number one reason why startups fail or become very big is not because of the team, not because of the idea, not because of the technology, but because of timing, right? Timing is key here. So the question is, if you are asking an investor to invest in you, the question to convince them really is, why now? What is the timing now? Why is it possible now, right? I think there's some stories out there that YouTube, if they were earlier, right, even earlier than where they launched, they probably would not even be where they are today. It's because of, at the time, Macromedia Flash, right, Adobe Flash later on, that actually enable all this streaming and everything that make them who they are today. But if they were earlier and broadband wasn't there, or at least the speeds were not there, they might not be who they are today. So I think it's really there convincing them to on the timing. Why should an investor invest in you at this time? And from the other side, the flip side of it, as an investor, the question is, is my job to deploy capital? Yes, my job is to deploy capital because we work for the LPs, the limited partners. These are the guys that have the money and they invest in the fund. So we do help them, obviously, to deploy the capital wisely, right? So we need to be able to spot the right companies at the right time, at the right valuations, right? No point you find a company that's worth $10 billion, but that it's going to exit only at 11 billion or 12 billion. Most investors will not be interested in that, even though yes, it makes money, but they want to really understand the trend. They want to know whether it's growing towards a 10x or 100x or whatever, right? They are looking for. So yes, my job is to really deploy money for TGV4 to the right startups, to the right team at the right time.
So to the layman or even the outsiders, right, they might think that the deploying capital is an easy job, but maybe you could deep dive, into telling us and sharing with us whether this is actually a difficult game. And do you also have to move to Silicon Valley? You mentioned that you visited Silicon Valley, right? Did you have to move there in order to deploy capital efficiently? And has the game changed tremendously, especially in the last 2 years, yeah, where a founder or a CEO can actually get on a Zoom call and then immediately bag a huge investment from formidable VCs like TGV, for example, or like, in the same vein of how, our previous guest, Gabby Dizon from YGG, he did, or he was able to pull off an investment from a formidable, VC as well to just, being able to just deliver social proof and also social currency. And of course, he had the right introductions and he was able to back investments like that, right? So it's all done through Zoom calls without even having to meet the VC in person. So maybe can you describe for us, for my audience, what is the process of startup founders actually getting these meetings, which, I personally know is not easy to get. And once they get into these meetings, right, what was it like? Is it like a chilled or relaxed, or is it like super high strung? Is it like culturally different depending on where they raise the money?
Yeah, so I'll first answer that first part of the question, which is yes, things have changed for sure. So for us, I can share with you a story, right? When we started the fund in 2019, and we were investing our own money initially, right? Because at the time, I think a lot of LPs, limited partners, they don't understand blockchain, they don't this space at all, right? So they're very unfamiliar. So we had to put in our own money and invest ourselves. And then only when they saw some success, then obviously they came knocking on the door. They said, "Hey, can we invest too?" And all this was in the midst of the pandemic, right? So a lot of them were asking us, "Hey, can we meet up? Can you fly down? Can we meet?" But then they realized very quickly that they can't do it anymore, right? They had to do it on Zoom or any video conferencing application, and so their mindset actually changed a lot. I would say the mindset actually changed. And for us, when we raised our money for the fund, we raised it actually a lot of it from Zoom. so in the same vein, a lot of our startups that we invested in during the time is also through Zoom, right? And it's not that we need to. I mean, it's best obviously to go there, have a handshake, have a beer, have a look the entrepreneur in the eye. But sometimes that's not possible, right? So I think the fundamental thing is that trust still has to be there. So like, for example, a lot of the LPs that invested in us, and also how we invested in our companies, is through trusted referrals. People who you trust that referred you to these entrepreneurs or who referred you to these LPs. And that trust then, obviously overshadows whatever format it is, whether it's going to be a coffee, whether it's going to be on Zoom, right? Because that the person that introduced you to this person is the one that you trust, right? So that fundamentally has not changed. So I would say that the mindset definitely changed. So the other thing that I think is also we need to look at is also the valuations and expectations of the different investors, right? So it really depends. If you are a startup founder and you try to maybe try to raise money from a country that is maybe not so crypto advanced, right? And you say, hey, guys, I'm trying to create this new DeFi thing or NFT thing or whatever. A lot of these investors who are more traditional will look at you, kind of weird and say, what is this, right? So I think having the right people on the other side of the video conference is very important, right? So we actually see, and I've actually heard of stories where people go on all these online networking. They find investors from other countries which they don't traditionally get, right, from their country. In fact, this guy was from Australia, and he was telling me the pains, right, saying, oh, Australian investors, they don't understand this part of my business, blah blah blah. But the moment he speaks to someone in the US or someone who understands his industry straight away, boom, he's managed to raise funds. So I think having the expectations and in fact even the valuations of who you're talking to, right? Because a seed a company in maybe in some countries maybe a few $100,000. That's fine. You can go ahead and raise it, right, very easily in those countries. But some seed companies, they raise tens of millions of dollars. So going to the wrong country with the wrong investors may be disastrous for that. Yeah. So I would say that video conferencing definitely changed the way that we all raise money, whether it's a VC or even a startup.
This is fantastic. Do you reject all startups who call you up and actually ask you for money? Maybe tell us about the last time when a startup or a blockchain company that really had traction, like maybe, you know, what is Mark Zuckerberg had when he built Facebook in Harvard University, right? He already had a lot of traction from his university classmates, yeah? So, you know, the deal that are closed via Zoom calls these days, does traction actually way more importance than talent? And is it true that VCs will only talk to startups with traction over grit and talent?
Yeah, so I think it really depends on the VC or the investor that is on the other side of the the video conference. I would say the early stage VCs, they know that traction is only one part of the the equation for them. So they really look at, I guess, team, like I said, timing. These are all areas that they need to look at. But obviously, for the more advanced companies, whether they're pre-series A or Series A onwards, they should have some sort of traction. So then I think the weightage or the way they look at it is totally different, right? In terms of how they invest and everything. For us, right, for TGV itself, because as I mentioned, we have 40 plus partners in over the 20 cities. It really helps because there should be some partners within the same country or region before we even talk to them, right? So let's say, for example, if I find a great startup in Singapore, right, and I think this has great potential for maybe, let's say, Europe, right, I would then talk to the entrepreneur here in Singapore first, maybe through a coffee or meetup or whatever, and then I would bring my other partner who's in Europe to come and speak to them to see whether my vision for them, whether it makes sense in those other countries, whether it's US, Europe, or whatever. Because I can think that it may work in Asia, but it may not even work at all in Europe or in US. And so we use this network in that way to be able to verify, right, that this company can scale to more than just Singapore or even Asia itself. So I would say that it's a combination of these few things. It's not just traction. It's definitely just not team. It's a whole combination of all this. And yes, we have done deals on Zoom before, as I mentioned, and so we won't turn away, as long as they meet our criteria and our mandate.
This is brilliant. I'm loving this conversation so far and learning tons from you. Maybe tell us, and tell our audience as well, why is capital just so important? And why has it become like the crux of every startup these days? Is the liquidity the most important thing for an entrepreneur and building network? Is it even more important than when you have traction?
Absolutely. So we always say, right, liquidity or money or even funding is the lifeblood of any organization, be it a startup, be it SME, being a big organization. If you just don't have cash on hand, you're going to be on credit. And you know what just happened on having too much on credit, right? Or too much, loans or bad debt. So this is a problem, right? And of course, every entrepreneur should have some lifeblood, right? Whether your runway is going to be 6 months, a year, 2 years, or whatever, you should be able to have enough of this lifeblood, which is cash or money, right, in the bank, so that you can, continue running the business. So I would think that networks are definitely very important. I've seen two very seemingly similar companies, right, in my time. Technologies about the same, team experience about the same. Everything almost looks identical. The only difference is that one had a good network because of their investors, right, and the other one did not, right? They both almost have very, very similar funding, right? But one had a really good, investor base that could help them scale very well. And guess what? The one with the network is actually the one that did better. Why? It's very simple. Because when you invest in a VC or when you invest in a startup, you are essentially investing in not just the team and the technology, but you're investing in their relationships. The relationships that they have built over the years, over their career, over their, whatever they've built in terms of the brand, their personal brand. You're investing essentially this, right? If you want to open up the door, let's say, for example, of a major telco, right? Let's say, for example, in this case, the startup may be selling to a major telco. One can just pick up the phone and say, hey, talk to the CEO and straight away, kind of close the deal or pre-pitch them. The other one has to go through, many different ways, right? Going through LinkedIn, cold call, cold email, you name it, right? Cold tweet, whatever, just to get to that same CEO. Who's going to win? The one that can pick up the call and say, hey, remember me? I made you money, or my brother is your best friend, or whatever, right? Some relationship that's warm, that opens up the door so that you can close it. So it's really the relationships that makes the difference. And sometimes it's so difficult to quantify that. that even startup founders or even VCs kind of glaze that through their head. They don't really see it. So those unfair advantages, we call it, right, are really something that startup founders and even VCs or investors have to look out for.
This makes so much sense. And what would you say to the uninformed who think in many ways that VC is actually a Ponzi scheme? Do funds that are not Sequoia, for example, like we know that they have like 3% and 30% take rate, right? And they still enjoy like annual management fees of like 2% or like 20%, carry interest or profit. So can you maybe tell us, this is definitely not the case?
I heard, Wayne, I heard exactly the same sentence being put on Play to Earn. First the whole NFT thing, then the whole blockchain thing, everything, right? Every part of the whole blockchain ecosystem, someone has been saying that it's a Ponzi scheme, right? Including, of course, DeFi and everything else. So this is something not new to me. But you must understand the definition of a Ponzi scheme. Definition of Ponzi scheme is that you only make the whole Ponzi scheme only can run if people insist on or they make money from recruiting the next person, right? Whether it's a downline or whatever. So there are elements of this because obviously you need to look at in terms of a growth of a company, right? So people confuse the growth of a company versus something that's unsustainable like a Ponzi scheme, and that's really the difference here. So VC itself has been an asset class since 1970s, right? In terms of kind of like the management and everything. It actually started even earlier than that, post-war, I think World War II. So I would say I'm pretty confident VCs is definitely not a Ponzi scheme. But that said, other asset class, we just have to be very, very careful, right? I'm sure most listeners, most people will know that a lot of crypto schemes, some of them end up really being a Ponzi scheme because you just have to keep on getting new people in before the whole thing actually collapse. So that's very, very obviously very, very something that you need to take note of, right? But I think this is the key part. If you make sure that the company has something, some value that's created, whether it's a game, right? Whether it's a utility, whether it's a DeFi or whatever, there must be something that creates value. If it's just money out of nowhere, then you just have to be careful that this could be a Ponzi scheme. Yeah.
I think you just broke it down for us really succinctly, clear, and well. How about that question, the second part of that question where I asked about the take rate, right? Do they still enjoy like 2% and 20% carry interest profits these days? These are the norm again in this day and age?
Yes. So funds, depending on different funds, they have different percentages, but 220 is definitely the norm or the average, I would say. Of course, those more successful funds can command obviously different rates. So yes, that is a typical rate of 220. 2% being the annual management fee. That means every year the basically the partners or whoever is running the show gets 2%, and then 20% when there's an exit, right? When there's successful profits being made. So yes,
thank you so much for clearing that part up for us. So our VC is actually pumping, for growth or even like superficial growth. Are these, phenomenon or are these trendy things to do these days? And do you think these are real issues? Why is it that every dollar that are raised, 40 cents actually go to marketing for superficial growth? And why are they focused on like a lot of vanity metrics and numbers like LTV or CAC and ignoring attrition numbers, for example? Is it no longer focused on like product market fit as long as you can keep raising, right? When you run out of money. So like founders or CEOs like these days, they spend like generally 90% on fundraise and maybe 10% of their time on running the company. So who actually gets screwed when VCs kept this perpetual thing going? Is it the young founders?
Yeah, so it's a good question. I guess it really depends on the VC and their strategy here, right? So every VC, I can't speak for every VC, but I would say that it really depends on the strategy. Most VC, they focus on that one, that unicorn or that game changer, that's something that is really, leading the pack, right? Because essentially that one company can return the whole fund for them, right? So let's say, for example, if I have $100 million fund and a startup basically, earns me $100 million, right? On top of the 100 million that I invested. So I would definitely invest my time and effort on that winner, right? So that's, I think, the mindset of a lot of the VCs, because they want to focus on the winners and not so much the losers or even those that are in the middle somewhere. And I think that's really a pity, because there are a lot of companies that you never know, where basically they're not winners today, but they can be winners tomorrow because something might have changed. Or even the people, so-called the people who are struggling, right? The companies that are struggling, they might be able to sell to someone, and that someone may become, one of the best investors ever. In fact, one of the stories I can share with you in TGV happened like this. Because of the structure of TGV, we don't every what we call founding partner basically hits maybe 1 or 2 or 3 deals, right? We don't take care of all the startups, right? Like in a typical VC. So in that case, that company that we really believe in, they are the only ones that will make us money, literally. If they tank, we don't make any money, right? We literally don't get anything, because in our fund, we don't pay our partners, the management fees. We don't get any salaries. That's the scary part of that, right? But we are incentivized on the carry. So we must make sure that the company actually works in order for us to earn something. In that case, even if the company is dying or is not doing well, we will never give up. In fact, that has been the ethos, that has been the DNA of TGV. We make sure that even the last company that, where one case where the founders actually left, there was literally nothing left in the company except the tech and the community. We still managed to find a buyer for the company, because we knew the network, we knew who would see it as an asset, and we managed to sell that asset to that person. And then after that asset grew and we make money. So I would say that we never give up on this. But as I would say, because of obviously the limitation of time and bandwidth, a lot of VCs, because they take care of 50 babies, 100 babies, 200, 500 startups, whatever, right? Different number of startups. They would not be able to focus on obviously those that are losing. And that is really a pity, because in our own calculations, at least for our fund, I don't know about other funds, that those so-called companies that are not doing well, they could make the difference of anything from 5% or even more returns for our investors. So why give up on those guys, right? Because those guys are serial entrepreneurs. They put in all their money, they put in all their efforts. We should also never give up on them, right? Until they say, okay, this is done and dusted, right? So I think this is the difference here. And why do VCs like to pump all these different things? Is obvious, right? Because the more the more sought after the company is, the higher obviously the next round could be. So VCs are like any e-commerce or any companies, basically, right? You buy low, you sell high, right? So if you buy low, you invest in $1 and you can sell it at $10, you made money, right? So the more you obviously try to pump it up, the more you expose it. Obviously, hopefully, the next round, you can raise more money. So essentially, that's how I see it.
Very insightful. More people are now also streaming into the private equity market, right? And they're also funding a lot of stuff. So why has the VC industry grown so much since the 2000s? And why are they all chasing the same deals? Maybe you could tell us, because we know that you have a history, because in terms of you're so familiar with it, you have lived through some of them. So what's the history here, since you have lived through most of it?
Some of it. I lived through a little bit of the .com, but I wasn't in the starting my career. I just started my career there. In fact, the .com part of it, I was just going to the army, right? So I personally think that in the 2000s, people saw a lot of growth, right, during the .com. There were millionaires popping up everywhere, right? Taxi drivers, everybody was talking about .com, investing and everything. And therefore there was lots of money, right, flowing in that area. So I think people then continue obviously to invest. Obviously after the .com burst, it was difficult, but then after that, obviously the money came back again. I think during the pandemic, right, during this 1-2 years, many of these tech stocks obviously did extremely well. So their business, because they were not as affected as compared to maybe, let's say, some of these traditional industries, right? So people say, hey, the yields here are good, right? The returns here are good. Why don't I pump in more money into the tech stocks, right? So I would say that there is a lot of money, obviously going to this area. And the fact is, a lot of these investors, whether they are limited partners, family office or whatnot, they're looking for higher yields, right? Investment. They are looking at, maybe their fixed deposits, maybe they're looking at certain areas that maybe give them, 2%, 4%, whatever it is. And they're thinking to themselves, hey, other people are making tons of money here, right? Investing in all these equities out there in the public markets or even the private markets. Why am I putting so much of my money here in this safer assets? Why don't I put it into riskier assets, right? like VC or private equity. So I think this definitely is one part to play. And of course, and no denying it, it's really the printing of money, right? In the last couple of years, the incessant printing of money to save the economy during COVID, during this time, has also benefited this whole industry, right? Because now there's money chasing, where are the best yields, right? Do I put it in DeFi? Do I put it in startups? Do I put it somewhere else? So definitely there's all these factors coming in.
This printing of money definitely, segues perfectly into our next question, because it's a little bit about fiat money. It's also about NFTs and cryptocurrency as well. So we know that there is this dynamic of if you are a LP or limited partner, right? You don't really want to be sitting on money that is like losing value, which needs to actually be on assets that are growing, right? And either like real estate or even NFTs. So there's this need to be on capital calls to see like realized returns on it after these capital are being deployed. So that is the question that I want to ask you. Is the melting ice cube effect of fiat money actually fueling this VC growth? And is this why we are liking cryptocurrency like Bitcoin and Ethereum so much?
There's many questions here, and it's interesting that you ask this. I think it's definitely multi-factor, as I mentioned, to the previous question of obviously the printing money, obviously on where tech stocks are doing extremely well. These are all factors that are definitely affecting all these things that you mentioned. I think it also obviously affects the rising prices of crypto, right? You can see very clearly, right? When there's bad news, crypto crashes 20, 30%, 40%, I don't know, whatever the percentage usually is, but typically is that, right? On a weekend, it crashes a little bit. Someone says, some country bans crypto and it goes down. And then after that, it starts to recover again. So definitely there is, all this money that's out there chasing better yields, better returns. And, people think that, maybe, instead of, buying so much gold, buying so much, the traditional assets, I would put some into Bitcoin, right? Because I see, Tesla, I see a lot of these corporates having Bitcoin in their treasury, right? So I think this is something that definitely affects, all these prices. The institution coming in, a lot of these new funds, right? Not funds, but companies that are going public, right? Like Coinbase, that have exposure, right? But they're not directly, right, into Bitcoin, but exposure into crypto, exposure into all these areas. So I think all these combination definitely has, affected this whole industry.
Thanks for breaking that down for us. I think let's take a short breather. Actually, we can't because we only have like 20 minutes left. Let's move on quickly, from the VC world to the angel world now, because you're also an angel investor, and we are all loving this guy, Naval Ravikant, right? I think he has a fantastic website and a blog which is called venturehacks.com, and he's from AngelList, of course. And his company AngelList kind of like changed the game, right? And he brought a lot of small or even smaller investors into the game. So can you maybe describe how it changed the VC game at the same time?
Yes, first I must say I'm a huge admirer of Naval. He doesn't know me. I've been following him, I think, for some time. I think he really affected the way that angels can access really good deals globally. The problem with angel investing, as I've experienced it before, is that typically when angel investor only invests in things and areas that he's very familiar, right, or she's very familiar with, and geographically usually constrained, right? So like when I became an angel investor, I invested in mostly Singapore companies, some Southeast Asia, but very, very few I've ever seen, in Europe or even US, because there's a perception that you don't get the best deals, right? By the time you get to it, it's probably oversubscribed, or someone has already done the whole round, right? So definitely with AngelList, this levels the playing field. An angel anywhere in the world can go on AngelList and find the best deals, to invest. In fact, recently I was talking to an angel investor. He told me, "Hey, I invested in OpenSea in 2018." I was like, "Oh my god, you made a lot of money, man!" So he said, "I went on on this platforms like AngelList to invest." I'm like, if this really changed the game, right? How would you ever access a company like OpenSea, right? Back in 2018, if you don't have platforms like AngelList. So I think these platforms definitely help a lot, and it's very, very helpful for the ecosystem, because now you can actually raise as an entrepreneur, you can raise money anywhere in the world, right? And you can also find very strategic investors. Maybe in your country you can't find such investors, but you can definitely find investors in AngelList itself. So yes, I think he definitely has changed the landscape.
I think that's an incredible story, that OpenSea story, right? I think he's considered an OG for getting into the game so early. So I think this also leads to the next question perfectly, because we want you to describe for our audience why having earlier, smaller rounds is the norm, and also happening organically, in the past 3 to 4 years. Why is the key is to actually get into the rocket ship, to spread and don't overthink it. Just invest in a lot of different companies, right? Fail fast and to move on if it's not working. And if it's working, just press, keep giving more. Keep giving them more money. Spray and pray, like, is it a great company or not? We'll maybe find out later. And this seems to be the mentality, right? So can you describe to us why this is the norm?
Yeah, let me tell you a secret. I mean, I know it's a secret when you're streaming it, live now, but let me tell you a secret here. The secret is that most VCs and angels, they don't know any better than the entrepreneurs themselves. So because they don't know any better and they cannot be experts in all domains, they use some of this spray and pray, right? So if you need money, okay, 20K here, 50K here, whatever. Because I don't know which may be the next, obviously Dapper Labs. I don't know which will be the next OpenSea. I don't know which will be the next unicorn that's out there. So the spray and pray method is the way to solve this problem, right? To say that I don't know any better. I see that you're an entrepreneur. You sound like you're saying something makes sense. I'm going to invest in this area. So that is, I mean, depending on the entrepreneur. In TGV, we are the opposite though. We don't take the spray and pray model. The reason is because we want to focus on the entrepreneurs and the industries that we believe we can value at the most, right? Number one, I think because naturally we only invest in serial entrepreneurs, right? So that's already a very small pie of the whole ecosystem, and then plus blockchain on top of it. So it's like double filtering, right? Serial entrepreneurs, blockchain, and then we want to look at the best deals that are at least at Series B or even Series C, right? Because they have attraction, they have some growth story and everything. So we don't take that approach because we're not early investors, unlike other funds, and so we don't need to take this strategy. I think that's the key thing here. But again, right, in terms of the strategy for spray and pray, there's nothing wrong with it, right? Because if you're an early investor, this is probably a great investment strategy that you should be using. It's really tapping on their brand, right? So if they're a good brand, like Sequoia and all these other brands out there that are top notch, it makes a lot of sense for them to go early because they can say, "Hey, I'm Sequoia, right? Come to me," and then your early startup can be Sequoia backed, right? And I think this is really, really good because they use their brands for in a way they're unfair advantage. But for the other VCs that are not as branded as maybe some of these top tier guys, then it's a bit more challenging because obviously they have to convince the entrepreneur. As much as you want to give money and the entrepreneur will take your money, they have to convince them, why should you take my money, right? How can I help you? How can I have you expand? What are my networks and all these areas? So I would say different strategies for different stages of investors.
And I really love, your strategy, and no wonder you guys are killing it right now. So we already talked about the VC, the angel game. It's like there's almost too much money, right? With money flowing in and not enough entrepreneurs. So that seems to be like the usual complaint from every VC, that I come across. So it is like always one hot company and then no one pays attention to the other companies, right? Why is that so? And also, everybody wants, obviously, the best companies. Everybody is like looking for the next decacorn or the unicorns right now. What do they do with all the money? Like, do they like invest in like huge advertising billboard ads in the airports, for example? Like, why are VCs not interested in those 10 million, those smaller but really good businesses? Don't you think that it's quite sad? They can only bet on like 100 to 1,000x successes or they go home. Do you think that, this system, actually produces Facebooks or Googles instead of like smaller but still great businesses who have to like take bank loans just to survive and even use their homes and collaterals?
Yeah, so it's a multifaceted question. So I would say that I'll start answering it this way. Different, as I mentioned, different VCs have different strategies. Not everyone must have the that 1,000x or 100x or whatever that they are looking for, but it definitely helps because that is the brand, right? So if you say, hi, I invested in, Facebook, I was the first one to put in a check, or I invested in this or that, whatever, right? That's very well known. People will immediately associate you with, being smart, right? Because you invested so early and, you are getting the returns now. So it's easy from a branding point of view as a VC or as an investor that, hey, you did this, right? But the sad truth is not everyone can get that, right? Not everyone can get the Facebook. No one can ever get the large unicorn that you ever invested. But they still make money because they are still investing in solid companies that are doing 10x, 20x, or even more than that, right? They don't have to have the 1000x or 10,000x. And I think that's the reality of this game, because how many of them are going to be like this? So the question is really whether these VCs, how they are investors, how they market themselves, and of course those investors, the LPs themselves, whether they are okay with a fund that makes money versus someone that says, hey, I only have one deal that does 10,000x, everything else lost money, right? So I think that's one factor. The other factor, I mean, I don't know whether you've heard of are you familiar with Peter Thiel's book 0 to 1?
Oh, yes.
Yes. So this is also another factor. There are many companies that are 1 to 100. Meaning, if let's say, for example, I see a great company in US, I say, hey, why don't I do this in Asia? Or I see this in Europe, I say, why don't I do this in Asia, or vice versa, right? So there are many of these companies that are 1 to 100, meaning they're not doing anything new, not doing anything groundbreaking. They're just taking a business model that works and just cloning it, right? In the last, I would say, couple of months, 3-6 months, I've seen tons and tons of NFT marketplaces pop up, right? Everybody's saying, hey, I'm going to be the next OpenSea, I'm going to be better, I'm going to be whatever, right? They're going to say all these things because it's all 1 to 100. But the key companies that are going to make the 1000x or whatever 100x or even a 10,000x are going to be the companies that are going to be the 0 to 1, the ones that started it all, right? The OpenSea in 2018, right, or whenever time they started it all, right? That believe that this is the way forward, and at the time nobody believed them, and only maybe the next few years you saw, wow, the trend is going up, and then all the money starts pouring in. So in order to focus on those, obviously those brand or those kind of like sellable brands, right? You obviously need to focus on those companies that are 0 to 1 rather than those 1 to 100. Not to say that the 1 to 100 is anything wrong. It does make money, and some of them make a lot of money, right? But it really depends on what is the strategy of the investors here, whether they want to invest more on the 0 to 1 or they are more comfortable with the 1 to 100. And we've seen of course, different localities, different countries, that some investors only go towards the 1 to 100 because they know those model works somewhere else. They're confident that the money won't disappear, right, or get burned out by the entrepreneur themselves. But there's only a few VCs and investors that really dare to invest into the 0 to 1s.
So what went wrong with WeWork? Because I believe they do have something that sets themselves apart from other projects, right? We can even call them like they're not the 1-to-1 projects because it's not like one of those same and look-alike projects like everybody's rushing to build NFT marketplaces right now, for example. So do you think that the world will actually come back to reality at some point to actually find real value? Like even Tesla, right? Which I'm not sure whether we could also say that they are a 0 to 1 company. They are now hovering at like 600 to 700, in terms of like their value, and when it used to be like 900 or even like further up. So what exactly went wrong with WeWork?
Yeah, I mean, WeWork, and there's a lot of stories on that. But from what I understand, reading, right, it's really not proper control, right? The fiduciary control, right, from their board and everything is very weak. So people, obviously the founder has been signing off on things that he shouldn't be signing on, conflict of interest, this kind of thing. So either nobody has questioned him or nobody dares to question him. So this kind of, I think, lacks control, contributed to the downfall of WeWork. But I think it fundamentally comes down to this, right? Whether it's WeWork, whether it's Tesla, it is really the human communication of the story that people buy in, right? So this whole thing's right, because from the time human communication has started, which I have no idea when, stories have been shared, and when people believe those stories, they become fact, right? They become realities, right? So I believe these top companies, whether it's Tesla or whatever they are, that manage to convince the retail investors or any investors that their vision is the correct one, will obviously become like Tesla, right? So I remember very clearly that Tesla was, this Elon Musk was talking about Tesla and the future of green energy and everything. And then lately, he was saying that actually, Tesla is a robotics company because I don't know if you heard of that. Basically, the cars are like robots, right, on wheels. But now we just have to put a leg on it, a head and an arm, and we are a robotics company, the leading robotics company, because we have computer vision, we have good batteries, we have good energy sources. We are robotics. So it's really that storytelling that is being done as an art, that when people believe it and say, they're actually, Tesla is a robotics company, right, the leading robotics company now, then obviously more money comes in, and they will get backed and everything. So I think that storytelling is so important, right? And I think people have looking at this area, they have to be very careful on someone who sells them a pipe dream, right, something that doesn't happen, right, versus something that they think might happen. And I think that's the difference between being foolishly putting in your money and versus something that you really analyze, you look at the trend, and then you put in your money and you back that particular company.
I think you nailed it on the head yet again, like what you mentioned about storytelling, right? It actually refers to genuine communication about your ventures and value addition, especially while you interact with investors like you guys. So I think this is super spot on yet again. Could you share with our audience why people, just want to pump stuff? Like even Elon Musk is guilty of that, right? With Dogecoin, and it's not really about underlying value these days, and maybe not even about fundamental value, but more on like acquisition or even popularity value, like NFTs. We will actually say that NFTs are a totally different animal, though, because there is real utility, like community. When it comes to DAOs, for example, there's a social aspect, there's gamification, there is the play to earn model that help people living in poor countries without jobs to actually play games for a living and actually earn like 3 or 5 times more than their normal wages. So like this, the average revenue for OpenSea, which you mentioned earlier, I think is about like $3 billion a month now, versus like maybe 10 to 15 billion industry for even like digital online advertising. So why is this space that we are all in right now so hot?
Yeah, I think why Elon Musk likes to pump stuff is because simply he can, right? And I'm sure he sees it as a game or something that he's able to do very easily, right? Obviously because so many people follow him and trust him. So just because he can, right? And because he's Elon Musk, he's able to do it. But I think the same risks are there for NFTs, right? Even though NFTs now obviously are very hot, right? Like for example, right, like when you say this OpenSea has $3 billion revenue. In fact, I think there was a report that came out very recently that a lot of their revenues actually are fake. It's not real revenues. They've been obviously getting people to pump it up, and obviously they have to admit to it. And I think in this case for blockchain, right, it's even more transparent. Everyone can see where your NFTs are going and everything, right? So that's how probably people got wind of it and call them out. So I think the same risks are there, right? Whether it's NFTs or even traditional companies. And I think because why it's so hot is because number one, it's a whole new innovation, right, that generates revenues, right? For example, for the many brands like the NBA, when they have NBA Top Shot, right, during the height of the pandemic, they obviously were not doing great in terms of the revenues, and they needed to innovate in terms of new revenue sources, and basically to monetize, right, the brand that they have. So I think that's one of the reasons why NFTs are so hot, because it gives these brands and these organizations a totally new revenue source that they never were able to monetize, right? So that's one. The second I think is obviously the growth of the revenues are exponential, right? Like for example, some of these like Axie Infinity, right? So a play to earn game like Axie Infinity, if let's say for example there's no play to earn model, it's just a typical game, I don't think the revenues will be so high. I don't think the usage will be so high. But it's because of this whole new play to earn. I can put food on the table. I can feed my family. I need to be on this game, right? Because COVID has obviously affected my livelihood. I think the virality of it is there, right? And play to earn is totally new. So people will jump through hoops. They will go through all the difficult parts of setting up a wallet, trying to get the crypto out into fiat and vice versa, because it really affects their livelihood. It's food on the table, right? So I think that's another reason why NFTs are so hot right now. And I think the third thing is obviously it's relatively new. A lot of media obviously is hyping it up, especially in the US. So it's getting in the psyche of the users. One of my partners was saying, right, when he was looking at the news in the US, he said, Kelly, every other hour someone is talking about blockchain, NFT, on the mainstream news in the US, but we don't see that here in Asia or even in Europe. Why is that, right? So it also plays a part in the psyche of the media, right? That talks about all these good things that are out there. Yeah. So I think these are some of the factors why we're seeing such why it's so hot, right, in this space right now.
It's very true. Just like, you go to LinkedIn, right? It looks so completely different than crypto Twitter or even Clubhouse, where NFTs are still the, top trending topic, and everyone's talking about NFTs in Clubhouse. So talking about NFTs still, do you still go on like Discord, like to look at active community numbers? Like you would, normally trade stocks, right? You would do tons of homework, like maybe in the NFT world, instead of doing homework with charts and stuff like that, probably you are doing homework that is about, maybe deep diving into like real engagement numbers, like rarity scores. Do you follow the other OGs in the space, or the other traders, right? Do you use tools like Nansen.ai or Nifty River or NFT stats, etc., to actually play against guys in the NFT world who completely understands the game and actually live in it 24/7?
Yeah, I wouldn't say play against them, but to understand where they're coming from. That radar, the tons of all these sites that talk about the stats and even insights, right? Like Delphi Research, all these guys have a lot of insights in all these areas. So I think the numbers is one thing, but the quality is actually equally important, right? Or in fact, maybe even more important, because obviously you don't want to have a community of people who are in your Telegram group and always screaming like scam, when Binance, when Coinbase, when Moon, right? You don't want that to happen every day, every second, every minute, right? People just saying that and just wondering when you're going to list, and then they can flip it and dump it and leave your community. You don't want that. So I think as far as the number goes, numbers is great, but quality of the community is also equally as important. And you want to see, what kind of conversations are happening in those communities, right? You don't want to have, just trading and flipping kind of conversation. So yes, numbers and also quality is very, very important to us.
Very true. Is NFT like VCs? Like, in other words, requiring money to actually continuously be pumped in. Otherwise, it stops completely. Are you blown away by the amount that are changing hands for NFTs right now? Like, there are so many projects that are like, breaking records, right, at this moment. Which projects actually surprise you in NFT top sales chart, maybe like the week that has just passed?
Yes, so I mean, these are all things that are trending up and down. So we obviously look very closely at all this data. No company or no project will always be growing, right? There's always times when they slow down or even drop. So I think these are all things that we want to look at from a mid to longer term basis, and not from a day-to-day basis point of view. So some projects that blow my mind. I think NFT wise, there's this new one that just came out by Time Magazine called Timepiece. I think a couple of million in terms of transactions already, and I think it's only a few days old, right? So it's a known brand, Time Magazine, bringing top creators and artists in. I think this is the way to go, because you don't want to be just having projects that are new intellectual properties out there that take time to build up, but you want to have known brands coming into the space. So that has one surprising thing. The other one that's from a game point of view. There's this game called Arc 8 for transparency, disclosure. We are invested in Animoca. Animoca is invested in Gamey. I think they bought over Gamey. So Gamey is the one that created Arc 8. So there's a chain there. I was blown away because the game is not even launched properly yet. I think they have an app for you to download. In the last couple of days, they shot up to 128,000 users, downloads and users for this game, simply because it was attractive. It's on Polygon, and it's something that's very, very new, right? And it's really casual games. kind of competitions, esport kind of competition using casual games. So it was like, wow, I never expected has so many users in a traditional game. If you don't talk even from a crypto point of view, I don't think you have this kind of growth, right? 128,000 users just coming in, right, in a couple of days. Yeah, so those are the kind of projects that blow my mind.
Yeah, these are really mind-blowing indeed. So everyone and everything, have a shelf life, right? So we can maybe, think about Kodak or Nokia, they are no longer, so focus on everyone's attention these days, or they don't even exist, So like if the Armani, speaker actually stops, what happens to this stuff? Will this entire house of cards actually like crumble down when these speakers stops? Is this like impetus for everyone to actually move more into crypto, especially Bitcoin, which is, everyone thinks is the most credible, scarce asset ever created by mankind, right? So even from like traditional institutional money and assets, what will actually happen to VCs in the future? Will they, or will you, ever lack LPs or limited partners? Would you follow the tracks of other VCs in the future to like either like disappear or fade away? Do you think that Bitcoin and crypto will actually take VCs out? This is a very controversial question, by the way.
Yeah, thanks for asking it. It's a good question. To your point, right, of Kodak and Nokia, I think Nokia now is the second largest 5G provider, just behind Huawei. So they definitely evolve, right, from the mobile phone that we all used to have, right, till now being still successful, but in a different domain. So I see it very similar to investments and even VCs. I think for VCs, the asset class has to evolve, right? This thing has been around, 50, 60 years. And now is the time to really see how technology can actually, evolve it, and also structures, right? I think things like, for example, even in TGV itself, it is something that we are exploring, right? It's something new to us even. How do we trade the interests of the LPs and the investors among each other? Today, how we do it is, basically you say, oh, I want to sell, and then they are say, oh, I'll help you find a buyer, right, to buy. How much do you want to trade, right? Then you do this very manually. You make sure that they sign contracts, and then you basically ask them to go and do the trade. But why can't we, digitize all this? Why can't we put this into digital assets, right? Whether they're going to be STOs or NFTs or whatever, but some ways to easily trade interests, because there are always new investors coming in and always people who want liquidity and want to exit, right? So these are things that we are always looking at, and as a fund, we're trying to innovate and see whether we can offer this kind of things to our investors itself. The same for any VC. I'm sure they're all looking into things like this. The second thing is decentralization, right? We are not a DAO, right? But we are, I would say, one step towards that direction. The reason is because, as I mentioned to you, we are 40 partners in 20 over cities. All of us don't take salaries. So in a way, we are distributed, right? We're truly global in a way. But sometimes we have to come back, right? Because we are Singapore registered fund under the regulation of MAS here in Singapore. So there must be some centralization, right? And there might be some decentralization. So I think there must be a hybrid model that exists, for these VCs. And if you really truly want to help your portfolio expand globally, you need that kind of network that is outside of the countries that you are most comfortable with. You need a global kind of network, and we will see. And I've seen some of these new DAOs come out, right? They try to act like a VC where they invest in startups really early and they can vote and everything. So we will, I'm sure, see more of these DAO type VCs coming out.
Very rightly so. I think recently there's been tons of headlines about how DAO could be the next trend after NFTs, and probably going to become another great valued asset class as well. So we have 3 more questions to go. So my apologies that this is slightly overrunning a little bit. So do you still have 10 minutes?
Yes, I definitely have 10 minutes.
Let's crush the next 3 questions. Yeah. What would you say to naysayers who insist that it is healthier not to be a decacorn or a unicorn CEO and become a slave to the VC and worried about being fired, instead of having to worry, right? Not having to worry about the next round of financing and just focus on having a live, and also those who insist that, there are so many things happening in the fiat economy, right? So VCs are sort of like a symptom of deployed capital as fast as you can so that it become, like a Keynesian beauty contest rather than underlying value. These are myths, right?
Yeah, so let me tell you another secret. I think some people know this, some people don't. VCs work for their bosses, right? And their bosses are the LPs. These are the limited partners that put in the money, right, into the VCs. And a typical VC, they would probably put in their own money, about 2 to 3% of the whole fund, right, as part of the skin in the game, right? So for them, for VCs, they are really about making the returns for their bosses, the LPs, because that is essentially what they're out there to do, right? Put in the money, put in the time, their relationships, help other people, invest this money so that they can all earn, a percentage of that whole profit that comes in, right? So in terms of the carry, in terms of their fees. But I think one of the important thing about this whole structure is that, if a company a tech founder can actually don't take VC money, it's a really good company, right? Especially in the tech business we're talking about. And so if there's any entrepreneur that can grow the company organically, right, and quickly without taking VC money, I'm all for that, because that is really the epitome of entrepreneurship, right? You don't have to take anybody's equity, you don't have to take anybody's money. You can grow it because it simply sells. So I think that is really the key here. If they can really be profitable from early on or even day one, but it's very, very rare, right? Especially in this technology kind of company. So unfortunately, a lot of the companies do take money from VCs, angel investors, friends and families, because they wanted the money to grow, right? Until they hit the inflection point or they hit the market fit, and then they can grow very quickly. So I would say that CEOs are not really slaves. I mean, most of them are not. Sometimes it's the opposite. The VCs are the slaves for the LPs or even for the founders, because they work so hard to help make sure that the company does not die and make sure that the company actually grows very quickly, because they need to help them find the next funding or maybe new clients or even new investors for the next round.
It's reverse slavery, for the lack of a good term or a better term, right? I think
Yes.
you have already taught us a few new terms tonight, unicornship, So let's go to the last two questions. You recently moderated at the TGV4's 56 Global Conference for the session on NFTs, just a hype or here to stay. So could you maybe describe the highlights from that session and what went down when you actually put all these individuals who are crushing it in this space right now, like we mentioned about Choo, the chairman of Animoca Brands, and of course, Sebastian Bogue, co-founder and CEO of The Sandbox, and Mike McCready, CEO and founder of Music X-Ray, in the same panel. How was the experience like for you?
Yeah, it was great. And I've been doing this for a couple of times now, and I think every time I host, Yad and Sebastian and Mike and others who come and speak, I'm always learning a lot, right? So every 6 weeks we actually run an event. It used to be crazy. We used to fly to many countries every 6 weeks when we could fly. Now we do it online and we do it global, right? But of course, different time zones for different things. So typically what Yat will always share, and he's definitely a visionary, is he talks about a lot of philosophical things about NFTs. Right? One of the best things I ever heard from him that came out from one of these sharing sessions, I think was even before this particular one, was that he talks about that NFT is really a store of culture, right? It's really where you store the culture and then people invest in that, and basically because they believe in that brand, they're willing to pay the premium and they're willing to stick with it, right? And to follow it till whatever time they want to flip it or maybe even hold it forever. So I know he said store of culture, and I really like that sentence. So I would say Yat has always been a visionary in that area. He's always been talking about the philosophical things. He was saying things like, there's no point, having walled gardens anymore, because if I launch an NFT game and my NFT can only reside on my game, it's the same as the traditional gaming, right? Well, it has to be able to move the NFT to many games, many metaverses, many different games itself. Then the true value of the NFT is there, right? So he's really open. That's why he invested in so many companies. I think more than 75 companies now under Animoca that invested in. So he always shares this really cool kind of philosophy as well as the trend. And then Sebastian from Sandbox has always the view of how do we bring all these brands into the metaverse, because from day one when Sandbox launched, right, they are like a Roblox but with NFTs, right? They really believe that it's not about just creating a good game. It's about bringing the traditional brands, whether it's Atari, whether it's Care Bear, Smurf, and even the crypto brands, all into the metaverse so that they can interact with each other. They can create new experiences. They just launched, I don't know if you saw, The Walking Dead, and also now Snoop Dogg, right? So Snoop is actually now in the metaverse. So it's not just about the games, but the experiences, discovering music, discovering the brands that people love into the metaverse. And he's been sharing very passionately about that and in those areas. So it really depends on of course the speakers, and every 6 weeks I'm always amazed that they come out with new insights and new trends in this. And for in that particular panel itself, they were trying to share that NFTs is not just a fad, and it's something that's growing. Even though in certain areas in NFTs, like NFT arts and in different areas, maybe there's a little dip, right, in terms of the transactions. But in terms of NFT as a whole, it's still a very healthy segment, right? Because there's collectibles, there's games, there's utilities, there's all these things that are growing, very, very quickly.
This is amazing. I think Yacht from Animal Cup Brands, right, could be the next Naval Navikant in the making, right? With his, philosophical views. And I could actually sense that, you had a lot of great fun interviewing him and actually moderating that particular panel. So my last question for you is actually quite simple. As co-founder of Refer Reach, right, we definitely have to plug Refer Reach, before you go. It's a peer qualified, trust-based network that actually makes networking, deal sourcing, and solution seeking more effective, efficient, and scalable. You are also the serial entrepreneur doing many things at once. So what excites you about getting out of bed every day? And why is Seth Godin, who's the X.com business executive turned marketing hall of famer, one of your heroes?
Right. So Refer Reach, a little bit of Refer Reach, right? Because I know I've been doing this entrepreneurship for many years now, and also as an investor, one of the biggest pains that I realized that I spent a lot of time was really networking, helping my network, helping them grow, helping myself grow, because I really believe that our net worth is our network, right? And I spent so much time, right, in events, 200 people going there, shaking hands, pre-COVID obviously, and then during COVID, I spent so much time on Zoom, having 200 people there, trying to figure out who is connected to who can I network with, trying to go for this digital kind of tables where you sit there randomly trying to find people. You name it, I've tried all sort of networking, I've networking groups and everything. And I realized there must be a better way of doing this, right? There must be a better way. How do I help my portfolio companies, right, when they need help? How can I help find people that maybe in my network is valuable to someone else, right? And I don't have to crack my head every day doing this. So the short answer is that I said, okay, let's talk to 50 people, right? Sane people who think that I'm doing something insane, because this is really a 0 to 1 thing that I've never seen existed yet. And I said, okay, let's do something that will solve this problem. And after speaking to tons and tons of people, VCs, angels, crypto guys, blockchainers, everybody that I knew, I said, oh, this is a similar problem with them. Let me try to solve this problem now. So that's how Refer Reach came about. It's still a very new company as I'm speaking. So we are now building an MVP, and we hope to launch this in a beta by the end of this year so that everyone can use it. There might be a blockchain element there somewhere, right? Just because I'm so deep into this whole blockchain space. But I think the real value here is, can anyone go there and build better relationships for themselves? Whether they're an investor, whether they're a startup person, whether even they're a business owner. I think this is the key question, regardless of whether they're blockchain or not blockchain. And that's where we want to focus on. And in terms of Seth Godin, why I admire him so much is because from young I've been reading his books, right? There's this book that really helped me think I would say very, very clearly in terms of what I wanted to do. And it was called The Idea Virus. It's about how do you get something that's very viral inherently. There's also another book called The Purple Cow. I don't know whether you heard of it. Basically, this premise is very simple. When you're driving on the road and you see like 100 cows on the side of the road, right? Most of them are brown. But if you see one purple cow, what is the likelihood that you will say, hey, look, there's a purple cow, right? So how do you then create ideas that stand out? Why would people, pay attention to you simply because you have social media, you're saying something that, tons of other people are also saying the same thing? What is that key thing that makes it remarkable, right? So I think these are all very simple to understand ideas that I take with me in my entrepreneurship journey and also in my investment journey, right? So I really I'm grateful of being exposed to Seth Godin and a lot of his ideas.
This is amazing. I think all the titles you mentioned, right? We should go, to Amazon right now to purchase those books. I think those are recommended reading, right? Especially for entrepreneurs and as well as for marketers. I think they will definitely learn a lot from those books that you just quoted. And of course, it's great that you're coming up with Refer Reach and, sparking more opportunities for more storytelling to be possible in the future. So thank you so much, Kelly. Thank you for once again, for coming on. I can't thank you enough. So keep crushing, and we look forward to maybe have you come back onto the show in the future. Maybe we'll invite Seth Godin, your hero, to come and jam with us together and do a threesome show together. What do you think?
Absolutely, or anybody else that you mentioned just now, right? In terms of here, I'm happy to share as much as I can. I'm always learning. And I think one of the main things about us in this space is that as long as we continue learning, we continue growing as people, I think that's the main thing. Because money can only go so far, right? In terms of resources. After you have a certain amount, you there's only so much you can do, right? Why Elon Musk is still crushing it and doing it? It's not because of money anymore, right? He's probably rich enough. His family can probably be settled for life many generations now. But he's very convinced that doing whatever he's doing now can change humanity and history, and it creates a small dent in the universe. So hopefully, I'm doing that part. I'm creating a small dent in the universe, and anyone hearing this, this stream can also create that dent in the universe.
Very well said, my friend. This is a great way to wrap up the show. It's 1 hour and almost 20 minutes. So I've learned tons from you. So please come back really, really soon. I really look forward to jam with you one more time. So please take care of yourself and take care of everyone over there. I'll see you very soon, my friend. Goodbye.
Thank you. Thanks, Wayne. Thanks for
inviting. Bye-bye. Cheers. That's Kelly Choo, investor partner of Choo Global Ventures. I know that many of you have been watching this live stream and also learning tons just like me, from this show and just listening to Kelly share so much wisdom and knowledge, in this 1 hour and 20 minutes worth of podcast action right here on Engine Starter Saloon. But there's also another part or segment of the audience who are actually watching this and closely watching this because you're actually, interested to know about the magic phrase. I think that is probably something related to a campaign that you've been actually keeping your eyes peeled, for many days. And you've been actually, asked to actually come here and take part in our campaign, to tune in live and watch this show. And as part of your last task, part of our Gleam campaign, actually, required to actually find out from the phrase I'm going to read to you here in the next few seconds. So the phrase is engine starter to Pluto. So this is what the phrase that you've been actually, paying attention to for the whole past 1 hour and 15 minutes. So for those, who are tuning in because you wanted to watch this show featuring Kelly Choo and also to look out for the magic phrase, I'm going to just put on the banner below the secret phrase, right, that will help you to complete your task. And the phrase I'm going to repeat one more time is called engine starter to Pluto. Let me just copy and paste that right here on the screen down below. I hope you could see it. Yeah, it's called engine starter to Pluto. So make sure you screenshot this in case you forget about what I just said. Screenshot this so that you don't forget and you successfully completed all your tasks and completed this campaign as well. So with that, I'm going to sign off. And my name is Wayne Cheong. I'm the host and producer of Engine Starter Saloon. It's been, great fun doing this with Kelly and also with you watching live with us on all channels. So with that, I'm going to bid you adieu. I'll see you during our next show and live taping. Good night. Bye-bye.